Welcome back. We are back with Bhawana Chhabra, senior market strategist at Rosenberg Research, for more discussion on sectors of the U.S. stock market as earnings season is now just days away. It begins on Thursday with a couple of companies. PepsiCo is one, and then on the Friday, the banks, the big banks. We're going to talk about the banks in this segment. Why don't we begin with the REITs, the Real Estate Investment Trust? And I'll remind viewers that what we're talking about here is the U.S. stock market. So we're going to talk about U.S. Real Estate Investment Trust. But at Rosenberg, you've recently upgraded your view of the REITs. Yeah, why?
Yes. So the reason is economic backdrop. So I'll take a minute to sort of explain where we're coming from. When we launched our framework on what's priced in, we were positive on the market. We did foresee a tactical rally, which has sort of played out. But in the meantime, economic momentum has waned. Most of the economic data points have missed expectations. Atlanta Fed is running at 1% on nowcast for GDP. So we see it constantly getting downgraded. So we are firm believers that interest rates are coming and there is a possible economic shock in the pipeline. When markets have run up, you're sitting on profits, you take those profits and invest in defensive sectors. And that's the rationale behind upgrading REITs.
What about, we talked about consumer discretionaries in our earlier conversation. What about the staples? They are a more defensive sector.
Yes. So we like them. It's just that the valuations are high. So we would stick to segments like food retail, where the valuations are relatively better off instead of food, beverage, and tobacco. But we overall are neutral on this space. We would say that any dip in this space should be bought in. Right now, the valuations are expensive, so we are not outright overweight. We believe communication services, utilities are a better way to play defensively right now than consumer staples.
You think the staples have already been bid up somewhat?
Bid up, yeah. Right. But any correction should be brought in because they're fundamentally strong.
Okay, let's get to the financials. JP Morgan Chase, Wells Fargo, and Citigroup begin bank reporting season on Friday. What are you expecting from the banks?
So we are expecting a good quarter from the banks, and the segment has seen upgrades in recent months. So we believe any positive news, they should run up. It's a tactical overweight in the model portfolio that we recommend. So yeah, there's that.
Will the banks benefit from lower interest rates?
So it's a give and take. Basically, when interest rates are higher, they expand on their net interest margin. But when the interest rates are lower, they save on their provisioning costs. But overall, they have. When we talk about banks, I would also like to highlight there is a big divergence between the regional players and big players. What went down with Silicon Valley Bank, the diversified banks gained market share and their earnings have started to look stronger. Their provision numbers look better. Their balance sheet looks better. And that's why if I were to talk about that divergence, we like diversified banks over regional banks. There's a potential for tactical rally there. But fundamentally, we are wary of the CRE stress that's sort of brewing in the economy. And regional banks have a huge exposure. So if it was to take exposure to banks, diversify, we would recommend viewers to have a more favorable view of diversified banks over regional banks.
When the banks hold their conference calls, it's always interesting to hear what the chief executive officers see in the U.S. economy. What do you expect them to say about the U.S. economy? What would you be, if you could ask a question, for instance, to Jamie Dimon at JP Morgan, what would you ask?
So I know for sure capital markets are thriving, but what I'm worried about is the stress on the retail consumer. So I would love to hear their view, how retail consumer is coping up with the stress of high interest rates, especially as the saving pile has run out and they're piling up credit card debt, they're piling up on buy now, pay later. So that's something that'll be on top of my mind because I feel that's a potentially weak spot in the overall glow that we most of the times talk about.
Why don't we move to healthcare, also considered a defensive sector? It's a very big, very diverse sector in the U.S. Stock market. What are you expecting in healthcare, and do you see opportunity or value there?
So healthcare is, again, another sector similar to consumer staples, which is on higher valuation, And if I were to put it on a pecking order, it'll be lower in our defensive pecking order. We don't like healthcare so much. That's because the segment has been seeing consistent earnings downgrades. The valuations are high. All the good news is in the price. Pharma stocks, they saw earnings downgrade, but their prices went up. So that's something we are not very positive about. Yes, there's a bright spot in form of healthcare facilities. That's something we've been overweight on, and that call has sort of played out since the time we launched the product, but that's the only segment we like within healthcare.